A. Demonstrate understanding of mergers and acquisitions, horizontal, vertical, conglomerate, and leverage buyouts. Mergers and acquisitions, M&A, involve combining companies to achieve strategic objectives. A horizontal merger occurs between firms in the same industry to increase market share and economies of scale. A vertical merger integrates suppliers or distributors to improve supply chain control. A conglomerate merger combines unrelated businesses to diversify risk. M&A aims to create synergies. Synergies may arise from cost reductions, revenue enhancements, tax benefits, or improved management efficiency. Valuation and financing structure are critical in M&A decisions. Overpaying can destroy shareholder value. Leverage buyouts, LBOs, use significant debt financing to acquire a company. Future cash flows are used to service debt. LBOs increase financial risk but can improve efficiency through stronger management incentives and restructuring. B. Identify and describe defenses against takeovers. Golden parachutes provide substantial compensation to executives if they lose their positions after a takeover. They increase acquisition costs and may discourage hostile bids. Poison pills, shareholders' rights plans, allow existing shareholders to purchase shares at a discount if a hostile bidder acquires a certain percentage. This dilutes the acquirer's ownership. Staggered boards divide directors into classes with different election terms. This delays a hostile bidder's ability to gain board control. Leveraged recapitalization increases debt to make the company less attractive. Fair price and voting rights provisions protect minority shareholders that a white knight is a friendly acquirer invited to outbid a hostile bidder. These strategies protect management and shareholder interests. C. Identify and describe divestiture concepts. A spin-off distributes shares of a subsidiary to existing shareholders. The new entity becomes an independent company, allowing greater strategic focus. That a split-up divides a company into two or more independent entities. Shareholders exchange parent shares for shares in the new firms. An equity carve-out involves selling a portion of a subsidiary's shares to the public. The parent retains control while raising capital. Tracking stock is issued to reflect the performance of a specific division. It allows separate valuation without legal separation. Divestitures aim to improve strategic focus, unlock value, and enhance operational efficiency. D. Evaluate key factors in a company's financial situation and determine if restructuring would benefit shareholders. Financial restructuring may be appropriate when a company faces declining profitability, excessive leverage, liquidity constraints, or inefficient operations. Indicators include weak cash flows, deteriorating margins, covenant violations, or declining market value. Restructuring can involve operational changes, asset sales, debt renegotiation, equity issuance, or cost reductions. The objective is to improve cash flow, reduce financial risk, and enhance long-term competitiveness. Management must assess whether the firm's capital structure aligns with its risk profile and growth prospects. Shareholder value impact is central. Restructuring should increase firm value beyond associated costs such as transaction fees or reputational impact. Careful financial analysis ensures restructuring decisions are value-enhancing rather than reactive. E. Identify possible synergies in targeted mergers and acquisitions. Synergies occur when the combined value of two firms exceeds the sum of their standalone values. Cost synergies may arise from economies of scale, elimination of duplicate functions, or improved purchasing power. Revenue synergies may result from cross-selling opportunities, expanded customer bases, or enhanced distribution networks. Financial synergies include tax benefits, improved debt capacity, or lower cost of capital. Operational synergies may stem from superior management practices or technology integration. Realistic estimation is critical. Overestimating synergies is a common cause of acquisition failure, so projections must be carefully evaluated and discounted appropriately. F. Value a business, segment, or combination using discounted cash flow DCF. DCF valuation estimates the present value of expected future free cash flows. Cash flows are projected over a forecast period and discounted using an appropriate cost of capital. Terminal value captures cash flows beyond the explicit forecast period. It may be calculated using a perpetuity growth model or exit multiple approach. Accurate forecasting requires realistic revenue growth, margin, capital expenditure, and working capital assumptions. The discount rate reflects business risk and capital structure. WACC is typically used for firm valuation. DCF analysis supports valuation of standalone businesses and assessment of acquisition targets. G. Evaluate a proposed business combination using quantitative and qualitative considerations. Quantitative analysis includes valuation comparison, projected synergies, financing costs, and impact on EPS and cash flow. The net present value of the transaction must be positive to create shareholder value. Accretion/dilution analysis assesses short-term earnings impact. However, long-term value creation is more important than immediate EPS effects. Qualitative factors include cultural compatibility, management capability, integration risk, and strategic alignment. Regulatory concerns and stakeholder reactions must also be considered. A sound recommendation balances financial metrics with strategic and operational feasibility.